Hello there, I hope that you're doing well. During today's lecture, I will touch on the most overlooked trading topic out there, and that is trade management. We will look at how you can determine where your stop loss should be, when you're allowed to trail your stop loss, when you're allowed to pyramid into positions, and where you should take partials or take full profits. Buckle up, because this is going to be an important lecture. Many people get into the world of trading with the belief that it's very simple and that all they need is one price pattern and that will solve all their needs. Let me tell you something. That price pattern does not exist. Surely there are price patterns that you will gravitate towards to be your bread and butter trading setups, but if you solely look for a price pattern without the proper understanding behind that price pattern, you're doing yourself a disservice. You need to understand what invalidates that price pattern from working. You need to understand when that price pattern allows you to pyramid into a position. You need to understand when you should take a partial based on that idea that you have, or when you should close the full position. All these things are very important, but many traders overlook them. And the reason why they overlook those things is because they are not fancy. People want what's fancy. People want what is flashy. But in reality, you should pay attention to the boring and objective stuff. Before we can take a look at the rules of trade management, we must first define what a trade setup is in the first place. I just want to give you a general idea of what a trade setup is. For every single trade setup, we must know two things. First of all, we must understand where the market is at right now, and we must understand where we anticipate it to draw towards. This is our draw liquidity. If we are bullish, we are anticipating the market to draw from this current market price level to the price level above market price. The difference between these two price levels is the range that we could look to profit from. If we are bearish, it means that we are looking for lower prices, and it means that we are looking at the price of the current market versus the anticipated price, which is below market price. The difference between these two prices is our potential range of profit. Inside of the difference between these two levels, we can look to capitalize on the market fluctuation. That is the overall idea behind every single trade setup. I know that this is a very simple explanation of getting into a market move and where you want to profit, but this is really the foundation. If you have been following me for a while, you will know that I trade purely based off market maker models. Therefore, we will discuss market maker models briefly so that you get a feeling of how I manage my positions within an overall market maker model framework. First of all, we're going to take a look at the buy model. What I want you to see is that we consolidate up here and the market begins to drop towards the downside. Eventually, the market reaches a key level, and once this key level gets reached, we see the following occur. We see the market displace above the high, which set up the final run lower into the key level. The market displaces above that high, and when this occurs at the right time, and I see that we have likely formed the SMR, the smart money reversal, within a market maker buy model, I will look to go long inside of the retracement into the fair value gap that will form during that expansion leg higher. This fair value gap must function as support on price. The reason why is because that fair value gap sets up the displacement above the high. And therefore I know that we have now changed from a sell program into a buy program. My stop loss will either be placed below the swing low, which formed at the key level, or I will place it below the low of the bullish breaker. The market then begins to expand away from our entry into our anticipated direction. During this expansion leg, something of great importance will occur, and that's the following. We will see a bullish fair value gap get created. This bullish fair value gap must function as support on price in order for the market to continue higher to draw towards the original consolidation, its respective high. This means that we can then trail our stop loss all the way to the low in which we entered in the first place. But this allows us to do something, and that's the following. This allows us to enter again into a long position because we understand that this bullish fair value gap should function as support on price. When the market then expands away from this fair value gap and draws towards our original consolidation, I need you to understand what we have just done. We have just not only removed risk from the equation behind this trade setup, but we have also given ourselves the opportunity to pyramid into this position. Pyramiding is something that we will discuss later during this video more in depth. We can not only look at a bullish example, so we also need to look at a bearish example. For bearish examples, I look at market maker sell models. What I want you to see is that the market consolidates and eventually begins to reprice towards the upside. The market reaches a key level, and this is my point of interest. When I see the market form a swing high at this point of interest during the right time, and I see all of the algorithmic signatures that I'm looking for to confirm that we're forming that high, followed by displacement lower, I will seek to find an entry inside of the retracement into a bearish fair value gap, which will form during that displacement leg lower. This lines up with a bearish breaker which formed. That will be my first entry. My stop loss will either be placed above the swing high, which formed inside of the point of interest, or I will place it above the bearish breaker. When I then see the market expand away from my entry and a new bearish fair value gap forms, I need to see this bearish fair value gap function as resistance on price. If this bearish fair value gap does not function as resistance on price, and I see the market displace above the high in which I entered, that's a big warning sign to me to cut the trade. If I see the market, however, find resistance inside of that bearish fair value gap, I can look to pyramid inside of that bearish fair value gap. But that's again something which we'll discuss later. My stop can be trailed to the high in which I entered. When the market then expands in our favor, we will look for it to reach or draw liquidity, which is below the original consolidation. And when it does, that's the idea done. When it comes to taking profits, a lot of traders seem to believe that they should take their full position off at once. This, however, is not true. Partials are a great benefit for your own psychology, because partials allow you to slowly get comfortable with holding on to full targets. When you have a clear draw on liquidity that you are targeting, but you see signatures in advance of that draw on liquidity that you are not a fan of seeing, it is never a bad thing to take a partial, because that allows you to already pay yourself and to be content with the outcome of the trade regardless. Meaning, if the market reverses on you and draws back to your entry, at least you have covered commissions and you are in profit for that session or that day. And therefore, taking a partial is always a good idea when one of the following signatures is in play. First of all, when the market is failing to displace true equilibrium of the range from the original consolidation, its respective low or high, to the smart money reversal, its respective high or low. When you see the market fail to displace true equilibrium of this range, it's a warning sign that the market might want to fall back all the way back to your entry. When the market fails to displace true 50% of this range, it's a warning sign that the market might want to roll over back to your entry. When this occurs, the worst thing that you can do is hold on to your position. Why? Because you could easily have taken a partial due to that warning sign and at least covered commissions. If the market then displaces true equilibrium of that range, we can look for the market to draw towards the original consolidation. Here we need to pay attention to intermarket relationship, however. If we see a highly correlated market take out the original consolidation, whilst the market that we are trading on does not, that's a warning sign for us to take a partial. Because it's possible that they're setting up SMT there to then draw against our position. This is something that I had to encounter many times in the past, where I was targeting an original consolidation and I saw the market simply stop right in advance of it and then roll over all the way back to my entry. When I then looked at the highly correlated market, I saw that the highly correlated market already took out the original consolidation, and that was SMT playing out. Therefore, the moment that you see a highly correlated market take out the original consolidation, whilst the market that you're trading on does not, it's always a good sign to take a big partial. When it comes to take profits, I need you to understand that there are multiple protocols that can be applied. First of all, when we are trading in line with the higher time frame order flow, we can anticipate the full market maker model to complete. Meaning, if we have a bullish higher time frame bias, we can anticipate the market to draw towards the original consolidation, its respective high. This completes the market maker buy model. If we, however, are targeting a level that is above the original consolidation, its respective high, as our higher time frame draw liquidity, we can not only take a big partial at the market maker buy model's completion, but we can also leave a runner to draw towards that higher time frame draw liquidity. That runner then turns your short-term trade into a long-term trade. And if your draw liquidity is correct, that runner can cause your equity to grow tremendously. Now, if you're trading against the higher time frame order flow, or when there's no higher time frame order flow clear to you, what I would suggest you to investigate how many times the market tries to gravitate towards 50% of the range between the original consolidation and the smart money reversal. If you have, for example, a bearish idea in mind in which you are looking for a short setup, instead of targeting the original consolidation, its respective low within the market maker sell model, I would suggest you to investigate how the market will react to 50% of the range from the low of the original consolidation to the high of the smart money reversal. If the higher time frame order flow is not clear, it's never a bad idea to take a partial right here. Especially when you're a newer student, I would suggest you to be content with partials along 50% of the market maker model. You slowly gravitate towards full pools in which you have the strong liquidity of the original consolidation and you anticipate it to get reached. That takes time, and allow yourself to grow into that. We're now going to discuss how you can maximize your profits whilst keeping your risk equal or actually decreasing it. Let me explain. We're going to do this by pyramiding. Before we dive into pyramiding, I must say that the people that are completely new to trading and are completely new to trading ICT concepts should not look to pyramid, because pyramiding can be dangerous if you do not know how to do it properly. Therefore, until you have a clear understanding of order flow and until you're able to clearly recognize market maker models, I would suggest you to not look to pyramid. However, if you're at the stage where you're able to see all of the opportunities to get in within market maker models, please begin looking into this. Pyramiding is the process of increasing our position size behind a trade. Please note that we only look to pyramid into winning trades. We never look to pyramid into a losing position. When we have an entry established inside of the low risk phase and we see the market displace away from our entry and a new bullish for value gap gets created, we can look for that bullish for value gap to function as support on price. I already outlined that this bullish for value gap has to function as support on price. When you understand this, you are able to understand that you're allowed to throw your stop loss to the low in which you entered. And here comes something interesting. When you throw your stop loss to your entry price or in close proximity to it, it means that you're decreasing risk significantly. However, if you want to keep the risk equal for the whole position, what you're then allowed to do is you're allowed to pyramid inside of that bullish for value gap, because you're anticipating that it will function as support on price. What this looks like is the following. If you go long 3 contracts initially, you're allowed to go long 2 contracts in the next entry opportunity. This means that your average entry price will increase, but you will also be able to increase your stop price, and therefore your risk will remain relatively equal. The moment that price does expand in your favor, you will be able to have a tremendous win because you have kept the risk equal, but you have increased the position size, and therefore you have increased the profit potential behind that position. Let us take a look at pyramiding from a bearish example now. If we are anticipating lower prices for this market and we see the market run up higher into a higher time frame key level at the right time, and we see the signatures that we're looking for in order to confirm a high formation, followed by displacement lower, we can look to go short inside of the retracement into the bearish value gap, which will get created. If we go short inside of this bearish value gap with 3 contracts, with a stop being above the swing high, and the market displaces away from that fair value gap, creating a new bearish value gap, we can look for that bearish value gap to function as resistance on price. Remember how I explained to you how we can throw our stop losses. When we understand that this bearish value gap should function as resistance on price if order flow is in fact bearish, we can look for our initial stop price to be lowered tremendously. If we are able to trail our stop loss then to that previous high in which we entered, we are able to remove risk from this position initially. But if we decide to want to keep risk inside of this position because we anticipate our analysis to be correct, we can look to pyramid inside of this bearish value gap, and our stop loss for this pyramid entry will be above that previous high. That is an intermediate term high. That high should not get displaced above if order flow is bearish. This allows us to go short with 2 more contracts, making the total position size 5 contracts short now. If the market then expands away from this second entry, we know that our stop loss is at a safe place, and we could even trail it even more because the market should now deliver towards the market maker sell model, its original consolidation. The moment that price trades below the original consolidation, the market maker sell model is completed. Now, what I need you to understand is the following. Notice that within these examples that I've provided to you, we decreased the amount of contracts that we were adding inside of the pyramid opportunities. We did not go from 1 contract as our initial entry to 2 contracts as our pyramid entry. No, we went from 3 contracts as our initial entry to 2 contracts as our pyramid entry. We never pyramid from the bottom to the top. We always pyramid from the top to the bottom, meaning our biggest entry comes first. Always, because if you don't and the market runs against you, you will see that the damage will be increased significantly. But if you pyramid from the top to the bottom, where you have your biggest position initially on, and you pyramid onto that position, always with smaller positions, whilst you're managing your risk accordingly by trailing your stop losses, you will see that you will be able to manage your positions accordingly whilst keeping risk relatively equal. And that is the goal, to keep the risk relatively equal as long as the analysis that you have created is playing out. If the market then delivers towards your final target, the profit behind that position will be increased tremendously relative to, for example, only having 1 entry in. Remember, if you're completely new to trading, this is an advanced method of entering. So therefore, stick to 1 entry. But if you're more advanced already and you have more experience, you can look into pyramiding on demo accounts at first. With that, this lecture comes to an end. During this lecture, you have learned how to manage your trades accordingly, how to manage your stop losses, how to take partials and when to take partials, when you're allowed to trail your stop losses, and how to pyramid and when to pyramid into positions. I hope that you found this lecture insightful. If you did, please leave a like and comment, and I wish you all the best in your trading journey.
Your teaching and your content has made me 100-fold better as a trader.
Now, maybe 4 months or 5 months in your mentorship, I've saved myself years. It's been incredible.
Now I actually have a model. I look in the markets with a different perspective. I can anticipate where the DOL or what our DOL is for the day.
I don't think I would be where I am right now without your guidance and help along the way.
Like, my eyes are so open to the market. I'll predict something and I'll see it happen.
You gave very specific guidelines, and within that I noticed it made even backtesting a lot more simple.
I know exactly when to look for trades and when not to look for trades.
You should be paying a lot more for this information and the way that you break it down.